conversation with Jim Hayes, Lucerna Capital.
Yep. So thank you again for agreeing to speak with us. In this conversation, we want to dive into how investors think about emerging markets today, from capital flows and risk to where real opportunities lie. And we would love for the conversation to flow naturally. So I guess to start off, can you tell us a bit about how you got into markets and why did you start your own hedge fund?
Yeah, sure. Well, thank you both again. It's a real pleasure to be on with you. I've been investing in emerging markets and working with emerging markets for my entire 35-year career. Started as a Latin banker with Morgan Stanley in New York. Went down with one other person to open their office in Mexico City in 1994. Worked with Bain and a handful of their international offices, including Istanbul and Johannesburg. I was at a hedge fund in Brazil. Came back and went to business school here at Penn, where I focused on international investment management. From there, I came out and worked in two hedge funds where I was the TMT guy, or I was focused on TMT. But really, given my background and interest, that ended up being a lot of emerging markets focused TMT. So at the time, it was wireless telecom, early internet, broadcasting. I realized that my real passion lie on the emerging market side rather than the TMT side. So when I had the opportunity to switch over to Fidelity and to broaden out and become more of a diversified emerging markets investor, I took it. I was at Fidelity for most of 14 years, the vast majority of which I was a co-portfolio manager on the Fidelity Emerging Markets Series Fund, which was about 35 billion at the peak, so the largest active fund in the asset class. And we were fortunate to be top 15% performers during that period of my tenure, despite being the largest fund in the asset class. My co-investor Brent Bottomini was also at Fidelity. He ran the Latin America Fund, which was about $9.5 billion at the peak and also the largest fund in its category. And I think I'm broadening out, but beyond your question, I guess I'm going into our background, but it leads into why we're doing what we're doing. We came to the realization that we thought the asset class had gotten secularly interesting after a 15-year bear market. And B, we thought that there might be, a better mousetrap and a better way to invest in it than having a vehicle that was as large and inflexible as the ones that we were involved with at Fidelity. It's a great place, it's a great institution, but we wanted a more nimble, flexible vehicle that was able to look at other parts of the spectrum, mid cap, small cap, in addition to the larger cap. And so that's what led us to Lucerna, and from there I'll pause.
That makes sense. I know you spoke about Fidelity. I'm sort of curious as to how your experience at Fidelity sort of shapes, I guess, your investment philosophy right now. Has it had like a drastic impact or?
Yeah. So look, I would say again, it's a wonderful institution. There's some really talented investors there. It was a great seat to learn from them. It was a great seat in terms of access to corporates and building out our network and our experience base. And we've got literally tens of thousands of company and analyst meetings under our belt between Brent and I over the years. So it was fabulous from that perspective. And there were investors there with different frameworks and different processes from the growthier side to the value side, and that focused on different things. And so in terms of forming our own investment philosophy and process, I think that long exposure in Fidelity was invaluable.
Right. So that's a lot of experience you've got under your belt, and we're really fortunate to be talking to you today. Just diving a little bit more, if you can, walk us through the changes that you've seen in the markets, in emerging markets over the last 15, 20 years, and how it's been and how it is, and where you think it's going forward. It would really give us a good
Yeah,
picture.
sure.
Yeah.
Absolutely. And again, I have this habit, good or bad, of expanding the question and then coming back to the actual question. So apologies in advance, and thanks for bearing with me. But how do I
No,
think
we love
about the
that.
good? Well, if I miss anything that was meant to be more pointed in terms of the question, please redirect me. But look, big picture, the emerging market asset class has a 60 to 70 year history.
Mhm.
And over that period, it's had longish windows, usually 7 to 10 years of outperformance, followed by longish windows, usually 7 to 10 years of underperformance. A lot of that is driven by the dollar, and sort of top-down macro factors, right? So as the dollar goes through periods of dramatic strength like it has over the last 12 to 14 years. Emerging markets tend to underperform. It tends to be difficult for them to post US dollar-based earnings growth. At some point, the dollar gets non-competitive, too strong, and emerging markets currencies will have gotten attractive again, and investment returns to emerging markets, which leads to an upcycle in terms of growth, earnings growth, multiple expansion. And we think we're at the tail end of one of those long down cycles and at the front end of one of those early up cycles. So that's the first thing I would say about how we're viewing the asset class at present. I'm sure we'll get into specific countries and sectors later. But to the other part of your question as to how it's changed, um, there have been different drivers over time. I think when you look into the last upcycle, which was really from 2002 to 2009, it was driven by China and China's pull on global commodity prices. And what was, it's clearer in hindsight than it might have been at the time, but what was a budding or expanding property bubble. We're now on the other side of that. That bubble has imploded, and we think that process is still unfolding. But interestingly, some of the drivers of emerging markets are similar. So you do have the AI and tech-related upcycle, which is pulling along portions of emerging markets in terms of the semiconductor and hard tech chain. But you also have a different commodity boom, which is in part driven by AI, and it's in part driven by global fiscal policies and the debasement trade, as one can call it. So the weakening dollar again driving an upcycle in commodities, which is again a tailwind for emerging markets. So those are some of the things we're looking at from a big picture perspective. And again, I'll take a step back and let you redirect me.
You sort of spoke about, I guess, the top-down and bottoms up approach that you take at Lucerna. I'm curious as to what drives your investment thesis, these days, given the rise of so much geopolitical uncertainty. Like, is it still bottoms up? Like, do you focus at equities first and then look at macroeconomic conditions, or is it the other way around?
So it's very much the former. We're very much stock pickers, ex-Fidelity, ex-Tiger Cub, in terms of background. And, really where we think our expertise lies is, within our industry specialization, finding, good opportunities that are mispriced and buying them well and letting them compound. So that's really what we're trying to do day in and day out. That said, emerging markets, you can't divorce the top down from the bottoms up. It's important to understand where a company's operations are based, what the fiscal and political and tax and regulatory backdrop is. And so, these are factors that we consider as well, both from a, how much money can we make perspective and from a risk perspective as we consider new or existing investments.
Hmm. Okay, that makes sense. You also spoke about how cycles tend to repeat, but I guess history shows us something that patterns don't really follow along for a long time. So, like, do you think that these EMDM cycles would still continue again, given the rise of the political uncertainty?
Well, I would say, 70 years is not 700 years, but it's a while. And I think that 7 to 10 year cycles. And this longest cycle, rather this latest cycle was a bit longer. The US dollar up cycle, was up for more like 13, 14 years. So it's the longest in that 70-year history. And I think what that means, for a variety of reasons, is that we're entering into a longer than usual upcycle for emerging markets. The starting point is attractive in terms of the relative valuations. The U.S. market has been driven narrowly over in the last couple of years, in particular, by technology, AI related, and we think that sector too tends to work in cycles, and we think that basically simplistically we're at the end of what has been a very long tech and growth driven U.S. cycle, and at the front end of what will be a more diversified and more broadly driven EM upcycle. You know, do I think it's the end of cycles? Do I think that EM will outperform for 30 years? No. Yeah, these cycles will continue. The imbalances will continue to build and then correct. But we think that this cycle that we're entering into will be a long and a strong one.
Okay, right. You know, right as we are entering into this, EM cycle, upcycle, what do you see as, the most major risks that could, sort of threaten to disrupt this upcycle?
I think they're more global than EM specific, which is a change. Some of the previous down cycles for emerging markets were homegrown, whether Thailand, Russia, this last one I think China was a big driver behind the downdraft. I think the biggest risk from this point is global and fiscal, and the fact that developed market and some emerging market banks have been running too hot for too long, and there's going to have to be a retrenchment where fiscal is going to have to, spending's going to have to go down or taxes are going to have to go up, and that's going to slow growth. So that's, I think, the biggest big picture risk. In
Okay.
other words, if the U.S. finally has to address politically or otherwise the bond market, forces to squaring the circle and the U.S. addressing its deficit, that's gonna drive up yields, which is gonna compete for capital, and that's gonna be a headwind for emerging markets.
This is sort of a silly question, but if you think there's a big sell-off in US Treasuries, do you think EM equities could still perform?
No, I think that that driver remains. As I say, that's a risk, right? If the U.S. market were to have a bond crisis and yields were going to sustainably reprice higher, I think that would be a headwind for emerging markets. I do think, though, at some point we'll have a recession, right? A global recession. It may be sooner than later, but at some point we'll have one. And I think that's where emerging markets really will be poised to shine. It will go down. The equity markets will go down in that scenario. But coming out of that scenario, I think that's where the emerging markets starting point and relative growth will really show and start to shine because the U.S. will have more imbalances to correct. The U.S. has been running the fiscal hotter for longer. The U.S. leverage across parts of the spectrum is built for longer. The private credit issues that are
Yeah.
emerging are U.S. specific. And so I think that, on the other end of whatever slowdown we see in the next recession we see, emerging markets will be able to, grow off of a lower base faster and more sustainably. And that's it's going to be, or is likely to be one of the drivers of what I described as a long and strong next upcycle.
Okay, right. Now coming to something that's on how we assess emerging markets. How do you think about the interaction between, let's say, fiscal policy and external shocks? For example, you have commodity-driven inflations when assessing emerging market resilience and investment opportunities.
Yeah. Um, Look, I think that there's not a lot of mystery behind uh, which are the countries which have been running the fiscal hot and being less responsible or less, conservative and investor friendly in terms of their policies. And I think that tends to be reasonably well priced, right? Turkey's an example where, um, you know, the policy is likely flawed, but it is what it is, and it's not likely to change into the next election. And so people just assume that they're going to lose money in the currency when they invest in Turkey. So any investment opportunity that you come across needs to be more compelling and have a shorter, uh, catalyst flow or time horizon in order to work. We rarely get over the hurdle. We rarely own things in Turkey because we assume we're going to lose 15 to 20% per year as dollar-based investors, right? So, I think that's the starting point. There are countries across emerging markets and developed markets which have been more and less conservative, more and less fiscally prudent, and one needs to understand that. But that part's not so hard to understand. The interesting thing to us is the identifying the inflection points, right? So we think we'll get into regions, but we can start now. We think Latin America is particularly interesting because after a 30-year period of dallying with socialist economic policies, the populace largely is ready for a change, and we've seen what we think is a structural shift. So it started with Argentina a couple of years back, Chile last fall, Colombia is this month, and then the big one is Brazil in October, where the elections have gone in a more investor-friendly and fiscally prudent direction. And we think that that's, again, kind of like our thesis on emerging markets writ large. It's the cheapest of the regions, and it's the one with the most identifiable and powerful inflection point or structural shift. And so that's a region that we like a lot.
Okay. I guess building up on what Rehan asked, in your experience, how do differences in monetary policy credibility across EM central banks influence the transmission of global liquidity and dollar cycles into local markets?
So this is one where I may ask you to redirect me because I could talk in a couple different directions. As I say, I think that there are a number there is a lot of dispersion across emerging markets. Some are some are fiscally more prudent than others. Others have more populist or election driven agendas and policies, and so that usually one can see in terms of what is the fiscal policy, what's the budget, what's the political backdrop. And then what we look for, what we like to find are inflection points. We like to find, change that started that we don't think is well priced in. And beyond that, if you could just redirect me a little with your question, I'm missing what specifically you're looking towards.
I'm trying to understand how, I guess, at Lucerna, you guys evaluate monetary policy decisions. Because again, there are a lot of biases within different economies. Um, Asia drives a sud- uh, Asia drives in a sudden way. With India, for instance, recently they stopped non-deliverable derivatives. So, like sudden changes like this, like how do you account or how do you make of what uh, the central bank is doing in such instances?
Yeah. So, there's a macroeconomic framework where we are, as I've said, and as per one of your earlier questions, we're very much bottoms up, but we do have to spend some time on the macro. It helps us analyze risk. It helps us analyze opportunity, and we understand macro, we think reasonably well. And a lot of that is textbook related in terms of what's the sustainable growth rate of a country structurally. What's the right fiscal interest rate and otherwise policy to get there. And usually, when there's a deviation from that, it reflects other goals than running the soundest fiscal policy possible. It reflects populist and political goals, right? And so that's what we look for: is what's the situation, what are the incentives, and what does that likely mean for the macro backdrop, for the growth, and for the currency. Um, to a question you didn't ask, we do like India a lot, and particularly we like financials there and private banks. It's just sort of the opposite of China in our minds, and in my decades in emerging markets investing, I find that EM or global based investors tend to like one or the other and not both. They're very different. But China, in our view, has overbuilt in every category and has created a structural deflationary environment with low predictability in terms of policy and excess returns. And India, on the other hand, historically, before this last set of administrations, it had a lot of volatility, and so therefore you hadn't had many durable capex and investment cycles, and so therefore India is still underbuilt in many regards, and most investments are therefore have a strong ROE and return profile, and are accretive as opposed to, again, most Chinese investment in sectors that are infrastructure related, for example, where they've already been overbuilt and they are projects that aren't justified by the return portfolio. So we like India a lot. We like the private banks, which is a sector where we find particular value. With consumers, some of the other sectors have sustainable growth, but we think they're better priced. So it's a sense for both how we think about the macro as well as how we think about India.
I guess I have two follow-ups on that. Um, you say you like Indian financials. Is it because of the major consolidation that's going on within the public sector banks and I guess the projected increase in fiscal spending by the government? And secondly, if India is so underdeveloped, like why is foreign investment still pouring out of India, which both me and Rehan find so surprising?
Sure, good questions. So I come at it from the perspective of someone who's looked at emerging market banks for 20 years, as opposed to someone who's looking at in the weeds of the budget from an India specific perspective. Um, and to me, there's a real opportunity or arbitrage from a valuation perspective, there aren't that many growth financials or growth banking sectors left in emerging markets. Most of the larger countries, the top line, the loan growth has slowed a lot over the last 5, 10, 15 years. And so India is one of the few, along with Indonesia and a small handful of others, where you still got sustainable mid-teens type top line growth for years to come, right? China slowed to mid-single digits. Big chunks of Latin America, even, which we like for other reasons, it slowed to mid-single digits. And so, if you think historically, um, that kind of growth profile has led to some pretty strong multiple expansion. If you think about, back in the day, what a Banco Itaú in Brazil would have traded at, or some of the Central Eastern European banks when they were growing at that kind of pace, they were trading at, you know, 2.5, 3.5 times forward book value, whereas some of the Indian private banks that we like trade at more like 1.5 to 2 times forward book value. So, I think it's one of the few sectors, the consumer sector in India trades at a big premium to global peers. Indian private sector banks have better growth and a lower valuation profile, and there are reasons for that. There have been some execution and communication issues, and there have been some credit cycles in the past, but we don't think that's where we are in terms of the Indian private sector banks. We think that the credit profile is pretty good. The rate backdrop and fiscal backdrop is pretty good. That growth rate is sustainable. The sector's underperformed for a bit due to the rate backdrop, and we think that's now reversing and improving. So, that's where we think the relative value is, and that's where we think the absolute return potential is.
Right. So once again, continuing on this topic, when you look at when you look at a country like India or any other emerging market, you do see, currency devaluations compared to gold or the dollar over time. So how do you account for this risk? For example, India, I think the rupee has lost around 8 or 9% in the last 6 months, which has caused, foreign currency outflows. So how do you account for this sort of risk?
Yeah, and it occurs to me that I didn't speak to part of your question from before, which I'll address here because it's related to this question as well, as to the outflows recently and the fact that that backdrop might seem optically confusing.
Mhm.
The bigger picture is, as both of you and many of your listeners will be aware, is that India has actually been of the large emerging markets, the best compounder over the last 5, 10, 15 years. It's the one large emerging market that's actually kept up with the US market in terms of dollar-based returns over that time horizon. Um, it can be chunky. Last year was a difficult year for India. Last year the market was, down double digits, whereas the asset class was up 25, 30%, driven by AI, driven by semiconductors, to a lesser degree driven by China. And I find that flows can be short term and chase performance and be fickle that way. And so I think it's partly just that combination of factors. Lately, it's lagged. Some of these other places have grown better, and so flows have gone there. But I don't think anything's changed in terms of a longer term structural backdrop that's been so supportive for India. And we would view this type of period of retrenchment, that in part is to your latest question, was driven by FX, right? The FX component has hit dollar-based returns, and that's also been one of the drivers for the outflows. We view that as noise in a medium to longer term perspective. And again, we think that this type of setup, where the stocks and the currency have lagged, and where the market has lagged other peers in the asset class, sets us up for a good buying point. So we like India here specifically.
Okay. I guess in terms of that, we're seeing, I guess, Japanese interest rates rise. Do you think that's going to have like a negative impact on emerging markets? The carry forward trades are reducing, and investors might find it much more safer and predictable to invest in Japan. So do you think that could be a big driver of EM outflows in the coming days?
I think it's a bigger risk for the US, right? Because there are some slight exceptions in Latin America and elsewhere, but for the most part, Japanese capital's gone where the returns have been. External Japanese capital's gone where the returns have been, and for the most part, that's US growth and equity markets, right? And so, what are they going to sell? They're going to sell what they own. If the Japanese rates continue to rise and people are, investors are pulling capital home. So I think it's a bigger risk for the U.S. equity market, but there will be pockets of EM that are vulnerable as well. I personally, rates have been volatile over the last few years after a long period of not being volatile. But there are drivers in both directions in terms of inflationary and deflationary global factors. I don't think rates are going to run away from us on the upside. If they did, it's a problem for equities everywhere, including Japan. But I think it's more likely that we bounce around in a range for a while, and that Japanese rates will rise, and then global rates will fall again as growth starts to slow, and eventually we probably will end up in a regime where rates are structurally a bit higher than where they were 6 years ago. But I don't think we're going there imminently.
Okay. Another follow-up. So historically, we've had Japanese development banks investing heavily in developing infrastructure in emerging markets. With rising rates again, like, do you think that's going to negatively impact emerging market growth with the reduction in
I think
infrastructure
that
spend?
I think that the flows and the capital will go where the returns are and where the growth is. Um, I don't I don't have the numbers in front of me, but my belief is, my understanding is that Japanese infrastructure related banks and government institutions, while they are a factor, they're not you know an overwhelming factor in terms of flows and investments into emerging markets, and that as if we're right that the asset class will do better and the currencies will do better and that the returns will be there, then we don't think it's going to be an issue for emerging markets infrastructure projects and stocks to generate flows and attract capital.
Um, okay. So you also mentioned AI, and AI is on everyone's mouths right now. And so I've got to ask you a question. How do you think AI is priced right now? Because we see most of the innovation happening in the US, and we believe that this is going to trickle down into emerging markets, pretty soon. And do you think this is going to affect the prospect of emerging markets in any time? Because we've seen software almost kind of collapse from all-time highs.
Yeah.
And yeah, so and we're seeing huge supply chain shocks too. So how do you think emerging markets are braced for that?
Yep. So I'm going to expand it to global AI and then I'll come to
Right.
EM. But I think, and I was around investing during the end of the internet period into 2000, and I think that this setup is pretty similar for AI as it was with the internet, which is that I think it's clear to most that AI will change the world and change most industries, just like it was clear in 2000 and 1999 that the internet would change the world and change most industries. Um, I think there's likely to be a pause between the investment and the returns that at some point is going to create an air pocket
Mhm.
beneath AI related stocks, including semiconductors. So we actually, AI specifically, in terms of those sectors, don't find the risk reward overly attractive, and we're not very exposed there. We've managed to keep up despite that, or win despite that. But certainly, semiconductors have been a nice driver of the asset class. We just don't find the risk reward attractive from these levels. Um, I think EM will be, I think EM will rhyme with that, so that some of the sectors that have driven recent returns, like semiconductors in Korea and Taiwan, and like those markets more broadly speaking, that will probably cease to be the case, and the return profile and the growth profile for emerging markets will broaden out into other regions and sectors. So that's how I think it plays out. And we tend to find what we do. Day in, day out, maybe is worth expanding. I talked a little bit about what we're looking for before in terms of compounders at a displaced valuation, and buying them well when we think that the reasons for their displacement are poised to improve or have already begun to improve. And so that ends up for us finding compounders across consumer sectors, across financials, and across sectors which are idiosyncratically based on the demand profile of the countries as opposed to big global drivers like energy or mining or semiconductors, which is, of course, a commodity as well. So that's, gives you a sense for both how we view the world and what we do day to day.
Um, can you give me an example of one of the most aggressive positions that you have taken since starting Lucerna?
Sure. Trying to think of which one to go with. We have a reasonably concentrated portfolio. So we have two products. Both are ex-China. We can talk about China more if you'd like, but both are ex-China. One is concentrated long only, 20 to 30 names, and the other is ex-China low net long short. And that's usually 25 names with lots of overlap with the long only book on the long side, and then 30 to 35 names on the short side. So I think one regional bet we've made has been on Latin America. We've talked about that. It won't always be the case. It's not a permanent structural argument, but it's certainly a temporary structural argument. So we've had big chunks of the book. We've had up to 50% of the book invested in Latin America, which is a nice overweight in the context of what the emerging markets ex-China benchmark looks like, and that's played out nicely for us. A lot of that's come from Brazil, but also Mexican financials and consumer. We've had some exposure to Argentina, which has worked out well. We continue to like that market a lot, and so that's an example of a big bet that we've made.
Okay. And what has been your favorite trade so far?
So we're not really traders. I know it wasn't really
Or a
necessarily your question,
position?
but
Yeah.
just to set the record straight, we really are trying to find compounders and let them compound. And we have, especially on the long only side, we have a very tax sensitive investor base, and we're very sensitive to that. So we've really worked over time hard to give good after tax returns, and that usually involves a longer holding period and not a lot of trading. But I understand that it was more of a use of a word than an actual description of what we're trying to do. The Latin America one that I described, we're pretty pleased with in terms of how it's worked out, and we still like it a lot. I think another stock that we've owned over time, that we talk about as an example of what we're trying to do is a Pan-African tower company. I won't name the name, but it wouldn't be hard to figure out. And when I was back in the hedge fund world in New York in 2002 to 7-ish, there was a stock that we looked at called American Tower, which at the time was about a $2.5 billion market cap, coming out of a period of high leverage, and the top line growth was starting to accelerate as smartphone penetration and data usage was starting to take off, and it went on to be an 100 bagger, literally up to a 200 billion plus market cap. And at this point, American Tower is still, out there doing well, publicly traded, grows the top line at 4%, and it trades at 36 times forward enterprise value to EBITDA. And this business that we like across Pan Africa, also has similar to that $2.5 billion market cap. They're accelerating the top line growth as smartphone penetration and data usage takes off in Africa and across their footprint. We think that they're going to be a 15% type grower versus that 4% that American Tower's growing at, and they're trading at 6 times forward EV to EBITDA. So that arbitrage is massive. Now, cost of capital is different. Will it ever get an American Tower multiple? No. But do we think it's going to continue to compound from here and be a multi-bagger? Absolutely, we do. And that's an example of what we're trying to look for, more broadly speaking.
Are you talking about Airtel by any chance?
No, that's a service provider. We know Airtel, but no, I'm talking about wireless towers, the infrastructure side.
Okay, because I've read about, I guess, similar positions being made within Airtel's subsidiary in Nigeria about how they've been growing the user base significantly as compared to the rest of the world. And this was an interesting article because the fund manager over there spoke about how he failed to account for I guess, the Nigerian government devaluing the currency by a lot. Like he had a hedged position,
Yeah.
but the hedge was only for, I think, like a 10% downside. But the
Yep.
government ended up devaluing it a lot more than 10%. In such instances, I guess, how do you actually value risk? Because obviously, these are things that you cannot see coming. Like, what would be a hedge fund manager's, I guess, view on this, and how would you try to protect your portfolio?
I would say a couple of things. The first thing I would say would be specific to, Nigeria and Brent and myself. We're fortunate that we've been in the asset class for decades and, including in that region. And so, yeah, with all due respect to your colleague that had the position, I would argue that that was foreseeable. There was a black market. The currency gap between the official rate and the black market rate was as high as 80, 90%. And so, perhaps a better hedge instrument would have made sense, obviously in hindsight, but I think that was a little bit more foreseeable. And there are other markets like that where you have that kind of backdrop. You can see what the real market rate is, even despite what the listed financial market rate is, whether that's currency specific or otherwise. But there are things that are harder to predict. That it is an unpredictable world and space. One could argue that the Russian outcome and war was unpredictable in terms of how it played out. Again, one could take the other side of that and say it was always going to happen as well. But it's an example, right? This is a gray area. And I think, what we try to do, and I think what investors in the asset class should try to do is we try to set targets on the upside. How much money can we make if we're right, based on what set of assumptions and drivers, and then a bear case. How much money can we lose if we're wrong? And whether or not a position gets into the portfolio and what size the position is going to depend on that math. How much upside is there if we're right? How much can we lose if we're wrong? How much conviction do we have that we're right? And what's the timing? Is it going to play out over the next 6 to 9 months, or is it going to play out over the next 6 to 9 years? And based on all of that, that determines whether something gets into the portfolio and what size it ends up being.
Right.
Do you think it's still predictable given how, or macroeconomic risk is still predictable worldwide given how the US has been acting recently?
I think that the world is less predictable than it used to be, and I think the U.S. deserves its share of the blame for that, for sure. There are drivers behind it, right? I think if you take a step back and think about why we are where we are, we're in a period of unprecedented, well, arguably unprecedented, but certainly rare pace of technological advancement,
Right.
right? Which has had big impact in terms of displacement of jobs across many countries and industries, and so that's had a political backlash, and that's frankly what led to the rise of Trump in the United States, I would argue. And I don't think that's a particularly actually controversial statement. Whether or not one likes him, that's what led to him coming to power. And it's not just America, and it's not just Trump. He's had an outsized impact for a lot of reasons, including just his style. But it's elsewhere as well, right? That in a lot of places, if there's any consistent political trend other than the polls being wrong a lot of late, it's that the incumbent tends to struggle. Which is what happened in the U.S. the last few times around, and other parts of the world as well. So I think that's important to keep in mind. We're just, given that backdrop, not just Trump, not just any given country's politics or policies, the real driver is the pace of technological investment and change and the displacement that's had on societies and sectors and families. And I think that's structural. That's the world we live in, and that's the world we're going to live in for a while. And eventually, we're going to get to an equilibrium that might involve a lot of different things. Higher taxes. It might involve higher regulation in the tech sector. I suspect it will. And that's going to be one of the drivers for that sector not performing as well going forward, and equity market returns broadening out across the world.
Right.
Do you think that equilibrium involves I guess, the world moving away from the US dollar into a, I guess, multi-currency driven world?
I think so. I think so. I mean, I think it would happen anyway. I think we're in a part of the spectrum or the the continuum anyway where the dollar had gotten overvalued and was going to weaken. But certainly, I think that weaponizing the dollar, most notably in the case of Russia and seizing the treasury positions, I think has driven a structural change in how central banks around the world think about dollar and treasury holdings, and it's one of the drivers behind what's happened with gold, for example, over the last couple of years.
Right. The next question is, I think listening to your answers for the last 20, 30 minutes, what I've realized is that while you're betting on emerging markets, you're also sort of betting on stronger consumer spending. So I think a question I'm going to ask is, which sector or which emerging market do you think is going to drive the strongest consumer spending, um, and why?
I might nuance your question a little bit, with regards to, I'm not sure that our big picture premise or our individual bottom up stock positions tend to be driven by the presumption that there's going to be stronger consumer spending. What we're really trying to find is individual companies where they've gotten displaced for whatever temporary reason, which is starting to improve, and we think there's value there over time. So I'd mentioned the tower company example. There are certain branded consumer names across the emerging markets footprint where certainly stronger consumer spending helps. But the real driver is, off a displaced valuation, the franchise and the brand are mispriced, and we're gonna do okay with the position, even if consumer spending doesn't pick up. So I would say that to start. And then secondly, in terms of, do we think we're going to see decent consumer spending backdrop across emerging markets? I think we do. Maybe not, amazing and rip-roaring in the context of the global backdrop that I described, where the fiscal belts in many parts of the world need to be tightened. But demographics are still favorable in emerging markets versus developed markets. I talked about Africa before, but Africa, India is still growing, but it's slowing quite a lot. Africa is actually where a lot of the global population growth is meant to come from over the next several decades. And it's a market that, because of historical underperformance and reasons behind that, many people don't pay attention to yet. So we think that's interesting. If we're right that the currencies are going to strengthen, investment's going to remain strong, you're going to have this backdrop of commodities, all of that should filter through and support consumer spending. So we do think it's a favorable consumer spending backdrop, but our investment process and bottoms-up choices don't rely on that strength, remaining the case necessarily or strengthening further.
I have two follow-ups. Firstly, you spoke about population growth. Do you still think it is an advantage to have a growing population in the age of AI? Like, if I were to give India as an example, because of the growth in AI, like, there is talk about how Indian tech companies might lose their offshoring advantage. So do you think that is a risk that you will take into account moving forward?
Yeah, it's a great question, and it's an important question, and I think it's one that's starting to be asked, but probably not yet being asked enough. Look, from the perspective specifically of consumer brands and development and growth, yes, I think the population growth matters. But to your point, and I agree, in a world with the amount of disruption that we've got and the potential disruption that will come from technology and AI related, population growth, bigger picture is a two-edged sword because you have to put those people to work in something productive. Otherwise, it's got difficult side effects, right? So that is going to be the challenge for governments everywhere, including in India. I do think that the IT sector in India is going to be vulnerable. It's another reason that that's not what we prefer versus the banking sector. If you think about the banking sector, there will be negative impacts, right? I think asset quality probably will be structurally a bit of a headwind in a world where there's this much disruption, but also There's the ability to gauge credit risk more accurately using data and using AI. Also, there's the ability to strip out costs as branch networks shrink, and a lot of that process goes digital. So we think on a relative basis, and again, in terms of absolute return profile, we think that our positions within a market like India are well placed. But absolutely, it's something that one needs to think about. And there are going to be some markets and some sectors and some companies that are going to be more vulnerable to that to others.
Right. Well, that's a wonderful answer. I think my next question is going to be a bit more direct. You spoke about how you're investing in China and these companies in Africa and all that. I think my direct question to you would be, what is your biggest risk to your thesis? What do you see as the one thing where you're sort of risking on and things could go haywire, and how are you pricing that in? Because
Okay, so that's
because
I'm gonna go more off the reservation. I'm gonna go more off base in terms of my answer to that question than maybe I have with some of the previous ones. But I think it will answer your question. So I would say from a global macro perspective, I've already referred to one of them already, in this call, but that's the fact that the global fiscal situation has gotten irresponsible in many places, and that at some point the bond markets will pipe up and suggest that that's not okay, and that's going to drive higher taxes and lower spending across big parts of the global footprint, and that's going to slow growth, right? So I think that's inevitable at some point. That's a question of when, not if.
Mhm.
And that I think is the biggest global risk because it should probably involve a recessionary backdrop eventually when it happens. And then the other one probably is China, which we've talked about a bit, but I haven't really talked about at length. And I'll give a little bit more color there for why are we ex-China and why do we think that more and more U.S.-based capital in particular is going to be ex-China over time. I guess the first point I would make is that we don't think that China is uninvestable, even for U.S.-based capital, but we don't like the risk-reward profile, and we think that for folks that want China exposure, it probably makes sense to get it through dedicated China-based investors that are close to the regulatory tea leaves, because that's a big driver in China. It's a market that has fundamental drivers that are different than many other markets that we look at. The second thing I would say is, to an earlier point, China's now shrinking from a population perspective. China, that's happening across much of the world, but China idiosyncratically, it's a result of their policies and the one-child policy, which they reversed too late. And then you've got that combined with the fact that you've got nearly 200 million units that are, sitting empty of real estate that were part of an investment bubble as opposed to a place for people to live
Mhm.
investment. And that leads us to believe that the Chinese property bubble is still in the fairly early stages of unwinding, and that property prices still have quite a bit yet farther to fall because you've got a shrinking population, you've got 200 million excess units that people would love to sell but can't. There's no real clearing process for most of it, and so eventually, when the price settles, it's going to be quite a bit lower. And if we're right about that, it's going to mean continued deflationary backdrop, slowing growth, difficult profit outlook, and the Chinese equity market, which is, and this is not an overstatement, it's underperformed on a 3, 5, 10, 15, 20, 25, and 30-year view, right? At some point, it's structural and not just a quirk, not just a glitch. And so we think, that remains the case going forward, given that backdrop, on top of the fact that obviously the regulatory backdrop in China is less predictable. It's a communist country, so they tend to take excess returns and apply them across other parts of the ecosystem. And if we're right on all of that, it probably means that the geopolitical risks are higher because President Xi might want to distract the populace with more nationalistic projects. And so all of these are reasons why we're not comfortable with the risk reward profile and why we think that more and more US based capital in particular ends up in the emerging markets ex China bucket. So a question that you didn't ask as specifically, but I think is important. It's an important viewpoint. We may be wrong, right? But that's how we view the world.
Yeah, it makes sense. Thanks for sharing that. So we got your view on risk. Now let's flip the side and look at reward, do you have like an annual returns target in mind, or does it just depend on what the market offers?
So we have two different products, as I've described. One that's the concentrated long only, and one that's the low net long short. And they have different investor bases and return profiles and targets. And I won't be too specific, but I will say um, we think the asset class is very attractively valued, and at the starting point of an upcycle, and so. Um, we've been fortunate to compound in the 20s in the long only vehicle when it was in pilot form and to more recent launch, and we hope to be able to continue to do that. Over time, that will come down over time as the cycle matures and on the law of large numbers. But we think that the current backdrop is pretty favorable for the long only for any long only vehicle in emerging markets, including ours. We think we can outperform for reasons that I won't go into here, but we like the asset class, and that's the kind of return profile we see for the asset class. Um, Maybe X some of the pockets that have been bubbly like AI, and so maybe the overall index doesn't grow at that pace, but if you select well within it, you can. And then the low net is more trying to be an absolute return vehicle and put up positive returns in all environments, and so it's more hedged. And so, there I think if we can put up a teens type return profile, I think that our investor base would be pleased.
Hmm. Um, the, so you've given us both your risk and reward. Do you think your strategy might over time evolve from just equities to a multi-strategy shop? Is that a possibility?
At least for me, you faded out a little bit for part of that, so I didn't catch all of it. I think you said beyond equities to fixed income and other instruments. Was that the gist?
Yeah,
Yes.
yeah.
Yeah.
Over time, do you see
Um,
Lucerna expanding to multi-strategy uh, funds products?
Look, I never say never, but it's not how we're thinking about the world at present. Brent and myself have a equities background and multi-decade experience base. Equities is a large asset class, obviously globally and within emerging markets. Equities, frankly, have lagged fixed income for a long period of time. Historically, looking back over the last 3, 5, 10 years, fixed income or multi-asset would have done better. And if we're right uh, about the fact that we're at the early phases of an upcycle, I think from here, equities specific products will likely structurally outperform multi-strat and fixed income. And so that's what we want to be is the go-to player for EMX China equities. And do we? I don't think we're going to feel a compelling need to expand beyond that to multi-strat anytime soon, if ever.
Hmm. And I guess you sort of spoke about this, but as information access improves globally, how do you see opportunities for alpha evolving? Like, is it mostly idiosyncratic stock levels or macro driven?
For flows investment or for direct investment or both?
In general, like for Lucerna, like how do you see alpha coming from? Like, is it going to be idiosyncratic, like from stock
Oh,
perspective,
alpha.
or
Alpha. Sorry. Okay. Okay. Sorry. I heard you say FI. So we think, first of all, we think that after a 15-year bear market, that the emerging market equities asset class is structurally less efficient than developed market asset classes, and that emerging markets were, 10, 15 years ago, right? So the average name that we cover that's, say, a mid cap, 5 to 15 billion in market cap might have five analysts covering it, and that same name in the US or in Europe would have, 15 to 25 analysts covering it. And the updates on the models are less quick, et cetera. So we think it's a structurally less efficient asset class, which we think provides opportunity for both vehicles, for the long only and for the long short vehicle. Um, we think it's an asset class that long experience matters, and Brent and I strive to bring that long experience to our process and return profile. And then we think focus within the asset class matters, right? We're not trying to be what Fidelity or JP Morgan or whomever might try to be in terms of covering, every stock within emerging markets that's got over a certain market cap or liquidity profile. We're trying to find something very specific. We're trying to find good businesses at a displaced valuation where things are starting to get better. And there are going to only be, a few handfuls of those that at least we can identify at a given point in time, and that's where we're going to spend our time and build our portfolio around. And we think that that's a source of advantage. We're not as index sensitive or aware as some of our competitors might be. We're just trying to find compounders and let them compound. And if we do it right, which we make mistakes like anyone in this business, but if we do it right, it's a powerful mousetrap, right? To be able to find a good business that's getting better and have a portfolio of those should allow one to outperform in both up and down market environments.
Right. Well, great answer. Seeing as to how we are sort of coming to time, I think before we part, I'd love to ask, we're just 23 and we're just starting off. So, we're trying to talk to industry leaders and figuring out how they think and how they go about their investments and their choices. So what advice do you have for other people in their 20s who are trying to get into asset management or just life advice in general?
An easy one to wind up with, huh? So I would say, first of all, congratulations and good for the two of you for launching your own thing and taking a risk. I think that's great. What would I say? It's one that I'd love to actually have the time to structure a more thoughtful answer, but I would say a couple of things, some of which are maybe cliche, but hopefully between the cliches, there's some wisdom. One would be to find something you love because you're going to spend a lot of your life working, and so you want to work at something that you care about and where this is the cliche, at least in the US, to describe it this way. But if you're doing what you love, it doesn't feel like work, right? That it's not work. It might be a little overstated, but nevertheless, you find something you love, work with people that you enjoy being with, because again, life's too short, right? And then maybe the one that's a little bit more concrete in my world and in our world, but is to be able to take a step back and understand the big picture and think slightly longer term than your peers. I think that can be an advantage, right? Not to focus on the next quarter or even year, but think out over the next, try to find great businesses that are mispriced. And if you're wrong, they're still going to be great businesses, right? And so that would be maybe the last piece of the bucket of advice I would give at this point.
Right. And just one question we love asking everyone, if not for asset management, what do you think you would be doing?
Well, I always wanted to be a business owner and an entrepreneur, and I had a background that had some diversions in that direction, which I won't go into here. But I think that, so therefore I'm fortunate in life that I've ended up where I wanted to be and my own boss. But it would have been that. It would have been my own boss in a different direction. There's lots to do from an entrepreneurial perspective, right? There are lots of secular trends out there and things that are changing and figuring out how the world's going to change and how to better address it using technology, whether that's, as the world ages, or as the world gets more automated, et cetera. So that's probably what I would be doing otherwise.
Sure. Thank you so much for your time, Jim. Thank you for making it. I'm sure our viewers will appreciate this. It was a lot of investing advice and wisdom. Thank you so much. This has given us a great outlook on the world and emerging markets right now. We really appreciate it.
Well, thank you. The pleasure was mine. I look forward to staying in touch and seeing what great things the two of you and your listeners do as well. And I'm sorry?
Can we take a quick photo?
Just
sure.
Yeah. Yeah, sure.
Yeah. Thank you so much.
Yeah. Thank you. Thank you so much.
Excellent.
Definitely stay in touch.
Thanks again. Be well.
Thank you.
You too.